Hello, and welcome to SBH's Investment Summit. I'm Robin Fujimoto. I'm a Director of Marketing and Business Development at SBH. Joining us today and helping us shed some light on the muni market is Mr. Nick Foley. Nick is the Director of Municipal Bonds and a Senior Portfolio Manager at SBH. Welcome, Nick.
Pleasure to be here.
Well, what a year it's been in munis. We're in uncharted territory relative to the last 20 or even 30 years from a yield perspective. And we've been seeing unusual volatility in the market. There seems to be a number of factors impacting the market, from yield hikes to Fed policy rhetoric to uncertain macro background. Can you help us understand what's really driving this market?
Sure. Yeah, I would say all of those things. So certainly a lot of uncertainty, certainly much more persistent inflation than we thought we would initially see at the beginning of the rate hikes. And now obviously some push and pull on as we've gotten to much higher rates, and the risk return payoff has gotten a lot higher for bonds, just finding a value that people think they're being really fairly compensated for, again, the outlook and the inflation picture.
So Nick, short-term munis have some pretty compelling yields. Can you talk about how they stack up against treasuries and money markets?
Yeah, absolutely. One of the more interesting things we've seen in the second half of this year has really been the rise of those front-end yields in the municipal bond market. So one of the things that was occurring last year through the start of this year is that although long-term yields were really rising, short-end yields were very compressed in the municipal market as investors were just very excited to even be buying 2%, 3%. It kept those yields very compressed. And so I'd say a big story about the second half of this year has really been that the front end of that yield curve has risen up to 4+% again for 1-year bonds, which, after tax, 4.15 for just a national highest federal tax rate is 7%. So we think that looks really attractive. Obviously, money markets, taxable money markets are yielding somewhere between high 4s, low 5s. So again, the ability to be in, high investment grade municipal bonds, if it's in a taxable account, is really attractive for someone that, again, may not want to go out and buy a little bit more duration, say in an intermediate portfolio. However, for our intermediate portfolios, we're really heavily focused on a barbell approach, and a really heavy barbell. So the reason for that too is the municipal curve is actually inverting pretty significantly. And so what I mean by that is that the yields are actually falling and then they're actually sloping back up again, just kind of in that belly of the curve, 7, 8, 9, 10 years. And so that heavy barbell, what it's really allowed us to do is capture higher yields, just a tiny bit further out, 12, 13, 14 years. But on the front end, with those front end yields coming up, with the other allocation of the portfolio, obviously it's making the total yield of the portfolio a lot higher. So really has made that heavy barbell even more attractive, really, in our mind.
Yeah, out in California, I'm loving those, the muni bond yields right now.
Yeah, absolutely. The specialty states, in particular, California, New York, Minnesota, Oregon, states that have high tax rates in their state, obviously those tax adjusted yields are even significantly higher. So pretty shocking to us to be able to see 8, 9% yields in California and New York for intermediate portfolios, as well as other high tax states. When we compare that versus what we think are kind of longer term return expectations for a majority of asset class, we would consider to be much more risky. We think it looks really attractive. So we're pretty excited. We're pretty optimistic about returns going forward, obviously just given the rate level we're currently at in municipal bonds.
Yeah, it's crazy getting those yields with investment grade instruments. So the important question, why use us?
Yeah, absolutely. We set out from the beginning to differentiate ourselves from the masses. So what I mean by that is really that there is a ton of options, obviously, to invest in municipal bonds, from essentially free ETFs, extremely low cost ladders, And our goal really, when we looked out across the landscape as we've been building this business, is that essentially the overwhelming majority of the municipal market is focused on a very small amount of the municipal market. So when we look at things, we see that 92% of all the outstanding municipal bonds in the market have a CUSIP size or a maturity size of 10 million or less, right? They're very small. And so as a very, very large manager, obviously, you have to be focusing on much larger, that other 8%, just so that you can obviously allocate bonds across a large amount of portfolios. So we think, again, our highest competitive advantage, which is just something that, competitors really can't do anything about, is just our size, right? So we think it's really important to be correctly sized for the market you're investing in, and the underlying structure of that market. And we think that the underlying structure of the municipal market is just incredibly poorly understood. And just by learning a little bit about it, we think it's fairly obvious why you would want to be in a smaller size shop that's obviously institutional, sophisticated in how we do all of our work around optionality, credit, all of those things. But again, a couple million bonds can be a meaningful size position for us versus a rounding error.
Well, I can see your passion come through, Nick, and we appreciate all the hard work that you've done for us. Everybody, thank you so much for joining us today. And if you have any questions, please contact your representative in your area. Have a good day.